Hi, Spencer here, and today I'm going to talk about how to identify market trends with swing counts. Now, if you recall in our previous video, we talked about the three main different market trends, and today we're going to talk about how you can identify or differentiate between the three different types of market trends. Now, if you recall, the three main trends were the uptrend, where prices are heading up, the sideways, where the prices are just moving sideways, and the downtrend, where prices are generally heading downwards. So now the next step is to be able to identify how do you know when the market is in an uptrend, a sideways trend, or a downtrend. Now, swing counts are one of the most classic and popular technique that is used by professional traders, retail traders. Actually, almost every trader uses this basic technique because it is so easy to use and it's also a very objective way that you can identify whether the market is an uptrend, sideways trend, or a downtrend. So first, if you look at any chart in the market, you notice that the prices don't just move up in a straight path like a rocket ship. It doesn't go in a straight up, right? If you observe the price movement, it typically follows more like a staircase where the prices move in a zigzag manner, right, with its ups and downs, but generally heading in the same direction. So one of the ways that we can identify the trends is to use the swing counts by observing whether the market forms higher highs and higher lows. So in the uptrend, you can see that it forms a higher high over here, and then when price drops, it forms a higher low, right? So this low, when you compare to this low, this is a higher low, and then it forms a higher high, right? This high is higher than this high, and then a higher low, right? So it gradually has this higher zigzag movement, right? Prices makes consecutive higher highs and higher lows. So you know that when you see a pattern like that, the market is in an uptrend. So similarly, if you look at the downtrend, it forms lower highs and lower lows. So this is the initial high. You can see that it forms a lower low here, a lower high, which is lower than this high, and a lower low, right? So this low is lower than this low, right? So it forms a zigzag movement that is moving downwards. Now, if prices are moving sideways, you will see a mixture of highs and lows. For example, a higher high, a higher low here, then a lower high, a lower low, a lower high. So when you see a mixture of highs and lows, generally that tells you that the market is in a sideways trend. Right? So just to recap, right? For uptrend, higher highs, higher lows. For downtrend, lower highs, lower lows. And for sideways trend, a mixture of highs and lows. Now let's look at an example of the chart. So I've annotated this uptrend chart with arrows that show this consecutive zigzag movement, right, of higher highs and higher lows. So you observe this chart has been making higher highs, higher lows, higher high, higher lows. So that's why it is an uptrend. So similarly for a downtrend, you can see the same zigzag pattern, right? So I did not label this chart. So you can treat it as a bit of practice. You can pause the video, right, and try to see if you can spot, right, the lower highs and lower lows as the market goes downwards. And lastly, in a sideways market, I've labeled some parts of the chart, right? I've labeled the first half of the chart with the higher highs and higher lows. So you can see that the market is a mixture of highs and lows, right? So it's pretty much a sideways market. So if you look at the other half of the chart, right, you can actually try practicing labeling the highs and the lows, right? And you'll know that this is a sideways market. So how is this technique useful for trading the market? The first thing is that it allows you to identify the trend. So for example, if you observe that the market's in a higher high, higher low, you know that you should be trading, you should be going long because the market is an uptrend. And if it's a lower high, lower low, you should be looking to short the market because the market is in a downtrend, right? If it's sideways, you can do both long and short, or you can choose to stay out of the market. The second important thing is that it tells you not to chase the price, because even if the market is on an uptrend, right, and the price is moving up very quickly, you know that the price will eventually have a pullback, right? Meaning it will actually come back a bit because it is a zigzag, right? It wouldn't go up all the way. So you can wait for that pullback to enter the market at a better price. Similarly, if you're looking to short on a strong downtrend, right, you do not have to chase the price and short at a very bad price. You can wait for the price to have a certain rebound, right? Because the market is going to have this zigzag movement. And lastly, it is an objective way to know when the trend changes. So for example, if the market is in a higher high, higher low, you know it's an uptrend, and the moment it starts transitioning from a higher high, higher low to, right, so perhaps instead of forming a higher high, this time it forms a lower high, right? So that will be the first early warning, you know that the trend is about to change. And then if it does form, after forming a lower high, it forms a lower low, right? Then that, is a sign that the market could be changing into a downtrend, and it forms even more lower highs and lower lows. You know that objectively the market is no longer in an uptrend, right? So since you want to always be trading with the trend, you need to know, right, when the trend changes. So these are three very useful ways that you can use swing counts to trade the market trends. So I've come to the end of this video. For more videos and market analysis, please visit us at www.synapsetrading.com, and I'll see you in the next video.